What's up, everyone? Welcome to the channel. I've had a lot of people ask how to do financial statement modeling. What I decided to do is assume that we start a YouTube channel. And in starting the YouTube channel, I'm going to go through the three financial statements: the income statement, cash flow statement, and the balance sheet. This will be really good for anybody who is maybe interviewing with a financial firm, or they want to take a closer look at the financial statements of companies whose stock they own. So we're going to blow this model up. Oops, not yet. We're going to blow this model up and start completely from the beginning, going step by step. I know it looks like a lot of numbers on the page, but by the end of this, you're going to know a lot about financial statements and how they interact together that you didn't know before. And my goal is to make this fun and easy and simple.
I hope this helps maybe a little bit.
Okay, so let's get started. So let's start with the balance sheet. The balance sheet represents a snapshot in time of the company's financials. So how much cash did they have on a given date? What were their inventories? What was the debt? All of those types of things. But we're going to do something really simple. So let's just assume you want to start a channel and you have $1,250. So that represents the sum total of all your assets. You don't have anything else, at least right now, just $1,250. But you also don't have any debt. You don't have anything else. So you have equity in the company that's worth $1,250. And you can sort of think of it like if the company were to liquidate and get rid of everything and hand the money back to shareholders, what would the shareholders get? Well, in this case, the shareholders, you have $1,250. If you decided to shut down the company, you just get your $1,250 back. Okay. So you want to start a company though, and let's say you don't have a computer. So maybe you spend $500 on a laptop. Okay. And now what happened is you started with $1,250 of cash, but you used some of it on a laptop. Your assets didn't go down. It's just that some of your cash transferred into the asset that is now a laptop, and your equity is the same. Let's go up to the income statement and see what happens your first year. So people on YouTube know that you basically get paid in terms of ad revenues on your views, and that the views are priced based on a per thousand basis called CPM. So let's assume that your CPM net to you after YouTube's take is $5. That means that your revenue for the first year will be $50. Okay, not too much, but maybe you'll grow a little bit. And let's also assume that you need to pay for an internet connection. This isn't an asset, it's just a monthly bill. But let's say that you're paying $50 a month times 12 months for internet. So you also spent $600 on your internet connection. Maybe somewhere down the line, you'll want to promote your channel with ads. But for now, let's just assume that you don't spend any money there and it's zero. Here's where we get to the first interesting part, D&A. What does that mean? Well, it's depreciation and amortization. Basically, any non-cash expense from a fixed asset or a hard asset that you purchased is typically depreciated over its useful life. So if you bought a laptop for, say, $500 in this case, and its useful life was 5 years, that means you would depreciate the laptop by $100 a year. Again, you already paid for the laptop. You're not taking another $100 out of your pocket. This is just how the accounting works. So let's see what our earnings before interest and tax was at the end of year one. And so you lost $650. Well, the cash came out of your pocket. You didn't borrow money from anybody, so you don't owe any interest. And you also didn't make any income, so you don't owe any tax. So your net income after interest and taxes was negative $650. Let's take a look at the cash flow statement. So every cash flow statement on every company always starts with the top line item as net income, which we just built down to. And the cash flow statement sort of adjusts for non-cash items. And what's our big non-cash item right now? Well, it's that non-cash depreciation expense. Because it wasn't a real expense, we want to back that out and add it to our operating cash flow. So our total operating cash flow was actually negative $550, not negative $650. We didn't have any capital expenditures, and capital expenditures are things like the laptop, but we did have a $500 expense last year. So I'll put that in here. Financing would be things like raising debt or raising equity. And remember, you put in $1,250, so plug that in right here. And your ending cash is just your beginning cash, which is that $1,250 you had in your pocket, minus the $500 you paid for the laptop. And we've got that going. So let's take a look at what the balance sheet looks like after your first year. So you started with $750 in cash, but you lost $550 in operating cash flow. you didn't make any capital expenditure purchases this year, and you also didn't do any financing. You didn't raise any money, you didn't borrow any debt, anything like that. So your cash position after your first year has actually dwindled by $550 to $200. And something happened to the laptop line item on our balance sheet as well, which is that it depreciated by $100. So I'm going to subtract that. And you can see now that our total assets have dwindled down to $600. And let's see what happened to our shareholders' equity, which is essentially the plug in this case. And so we want to take our initial shareholders' equity minus our net income for the year. Now, some people are going to be asking, well, how come you subtracted $650 from this number? How come you didn't subtract $550? And the answer again is that the idea of depreciation in accounting basically has to do with the idea that you have to expense assets over their useful life. And so in theory, you'll eventually have to replace that asset. And as a result, your shareholders' equity declines. So let's now see where we're at. By the way, I like to do a check just to make sure that the assets and the liabilities total. And by the way, the balance sheet always balances. Doesn't matter if it's a small company or a large company. You can go look and check at any company. The balance sheet will balance. So let's also update our change in cash here. We basically started with $750 in cash. We ended the year with $200 in cash, and our change in cash was $550. Let's see if that matches what we have on the balance sheet. It does. Okay, so everything looks good. So let's go to our next year. And let's see what happens. So let's say in our next year, things get ramped up a little bit. And for the full year, we have 500,000 views. Now let's do the same CPM. It means that our revenue would be $2,500. We still have to pay for the internet connection, and we're still paying 1/5 of that depreciation on the laptop. And this is a good year because we made $1,800. We still haven't borrowed any money from anybody. And let's assume that we pay 25% taxes. So I'm just going to put 25% over here. So we had positive net income after tax this year of $1,350, which is great. And keep in mind that that $100 of depreciation was non-cash. So we get to add that back, and our operating cash flow for the year was $1,450. Now, we still haven't made any upgrades. We haven't purchased any new computer equipment. We haven't done any financing. So there are no capital expenditures or CapEx, and there's also no impact from financing in this year. So let's take a look at what happened to our cash. So cash was at $200, and we added $1,450 to it. So that's our new balance. And once again, our laptop depreciated another $100 down to $300. And our total assets now went up to $1,950. Shareholders' equity, again, will just be our previous year's shareholders' equity plus whatever value the company created from net income, which was $1,350. Let's see if those two match up. Oh, they don't because I didn't do that. Okay, so they do. So this is great. And let's also connect our beginning cash and our ending cash. And we can see that it went up by $1,450. Let's check to make sure that that's true. And it is. Okay, so you kept growing your channel and you had a really good year. You got 1 million views your next year. And another $5 worth of CPM. And so you made $5,000 in your third year. You're still paying $600 for internet. And now we've covered the depreciation, so we understand that. And let's make it so you pay the taxes again. So our year is getting better. And let's see how much cash flow you made in year 3. $3,325. And by the way, this is a great return because you put up $1,250 in your very first year, and you're making almost 3 times that in year 3. So for any large scale business, this would be a truly phenomenal return. I mean, to put up $1,200 and a few years later or 3 years later be getting $3,000 is huge. So let's say your fans have become a little bit more demanding, and in the third year, do you decide, hey, I'm going to get some editing software, and that's going to cost me $250. Okay. And I have the money to pay for it because I made $3,300 this year. So let's just see what that does with our balance sheet. So our balance sheet is now being impacted not only by the income from our operations, the operating cash flow, but we also have to subtract the $250 that we spent on our editing software. And I put in a new editing software line item here. Let's say we do it at the end of the year on the very last day. So our asset value for the editing software is $250 because we haven't depreciated it yet. We'll do that next year. And again, let's take our previous year's shareholder equity and add up our net income from year 3. And you can see that the balance sheet balances again. By the way, I made a little depreciation schedule down here, but we don't really need it, so I'm just going to get rid of it. Okay, so your new editing software paid off, and you quadrupled the size of your business in year 4, and you now have 4 million views per year. Let's see what other changes had to be made. So your revenue goes up to 20K, which is great. Your internet costs are the same. And then we have a little bit of additional depreciation expense because we have the 100 from the computer, and we also have 1/5 of 250, which is going to be $50. So our total DNA is now 150. And so we now have almost $20,000 of earnings before interest and tax, and 14,000 of net income. Again, our depreciation went up, and we're good with our software purchase. We're happy with that. So we're not going to do anything else in terms of purchases in year 4. So let's see what happened to the cash flow. Let's see what happened to the balance sheet. So you can see that the balance sheet basically increased by $14,500, which is our operating cash flow for this year. So we started the year with $4,700 of cash, and it went up by $14,500. Our laptop is going to depreciate by another $100, and our editing software is going to depreciate by 50 for a total of 150 of depreciation, and that brings our total assets up to 19,000. Taking the shareholders' equity from the previous year and adding our net income means the balance sheet balances again. So this is literally how every single financial statement works. There are some line items in between these things that I can go through, but they're very simple. And if you get these concepts, and you can even rewind and go through this again, but if you get these concepts, you basically understand how companies that trade on American stock exchanges work. Okay, so now you're in year 5, and year 5 is going to be a big year, and I'll tell you why. Because you are quadrupling your views to 16 million, and you're quadrupling your revenues to $80,000. You're still spending $600 on the internet, so that's a fixed cost, which is great. And here's why your views quadrupled. It's because you took your ending cash, which was basically $19,000, and you borrowed an additional $20,000 worth of cash on the first of the year, and you use that to fund $40,000 worth of advertising. So let's see what happened. And this is crazy because you can see the big investment that you made in advertising really paid off because your revenues 4x'd and you had a lot of fixed costs that stayed the same, like internet and depreciation. So even though you had this massive ad spend, your profitability increased. And now you have interest expense. So we said that you borrowed $20,000, and let's say you pay 10% on that. So that's going to be $2,000 a year. So net of interest and taxes, your net income for year 5 was almost $28,000. And let's take a look at what this means. Let's go a little bit more in depth into the cash flow statement and the balance sheet. So the cash flow statement we know starts with the net income, which is the same as the number right here. Our depreciation didn't change because we didn't add to our fixed assets. Advertising is not a capital equipment expense. It's a selling, general, and administrative expense. So we don't need to affect our depreciation with ad spend. And our CapEx is still 0 because, again, we didn't add any capital equipment. We did get $20,000 from financing. So let's see how that impacts us. So remember, the cash on our balance sheet is affected by a few different things. In order to arrive at our year-end cash balance, we take the starting year cash, we add in our operating cash flow for the given year, we subtract any expenses associated with capital expenditures, and we subtract, or really add in almost every case, cash associated with financing. Obviously, when you do a financing and you raise debt, it means the cash comes in the door, but at some point cash goes out the door because you repay it. Anyway, let's copy this formula over and see what happens. So you can basically see that the change in cash was $48,000, and that's reflective of the operating cash flows of $28K from the business, as well as the inflow of $20,000 again from the financing. Our laptop has now been depreciated down to 0. So this is great because if you can use it beyond 5 years, you sort of have a free laptop in a way. Our editing software depreciated another $50. So our total assets at the end of year 5 are $67,550. The shareholders' equity is going to be $47,000, and let's just see if that balances. Oh, wait. Okay, so see, we ran into a problem here, and we've been checking the difference between our assets and our liabilities this entire time, and so far they've matched up, but something is not right here. And so what occurred? Well, basically, when you have a debt outstanding, that's an obligation that you owe to somebody else. It's a liability. So you don't count debt as value that you retain in the company. You need to take the value that you retain in the company less the things you owe. And therefore your liabilities plus shareholders' equity aren't $47,000. They're $47,000 plus the $20,000 of debt. So let me just link it up here. And if we did everything right, which we didn't initially, then that would balance to 0. That's it. I hope you enjoyed this presentation. If you have any questions, please let me know. And also, please subscribe. It helps make these videos so much better, and your support really means a lot. So thank you. I hope this is helpful to you in your journey, wherever you are and whatever you're doing. And I'll see you again soon.
If you have any questions, let me know in the comments. I'll try and answer some of them.